Electronic Arts, EA is being acquired. It's getting taken private sometime in the next year. And a lot of people are trying to decide, is now the time to go ahead and sell, take that cash and then reinvest it? I'm going to talk through what I think investors should do right now, whether it's time to go ahead and move on, and where I think a good place to invest that money if you want to stay exposed to the video game opportunity is. I'm Jason Hall. This is Investing Unscripted. Before we get into the details, though, we have a sponsor for our video. Our sponsor is the Motley Fool. If you're looking for even more great stock ideas, we got some interesting ones we're going to talk about, but the Motley Fool has even more. If you're looking for more great stock ideas, go to our special link. It's fool.com/unscripted. Go to fool.com/unscripted. You can get access to the Motley Fool's 10 best stocks to buy right now. All right, let's start here. We're going to take a look at how investors have done with EA. So I took this back to last Thursday, which was the last day before word started getting out about the deal for EA to be acquired and taken private. You can see the stock's up 20%. Take-Two Interactive stock has gotten pulled up along with it. Some investors are starting to wonder, hey, maybe is Take-Two a takeout target? Is it another one that might be on investors' lists? That does get me to the first question. Should investors move on from EA, take that cash and reinvest it? So a couple things to think about. One thing, how long have you owned the shares? Again, this is not individual advice for anybody. You have to make your own decision based on what's the right thing to do, but some things to think about. How long have you owned the shares? Do you own them in a taxable account? And again, this is for US investors. If you own them in a taxable brokerage and you've held the shares for less than a year, if you sell now, you're up big, but you're going to pay short-term capital gains rates. So that means you're going to pay more taxes versus investors that have held the shares for at least a year. So first, I would suggest investors out there really seriously consider, if you're holding a taxable account, you're a US investor, getting to that 1 year mark is probably a good idea, because again, you might lower you from paying 27% in taxes on your gains to maybe 15%, maybe even less, depending on what your earnings are and what tax bracket you fall in. So that's a starting point if you own it in a taxable brokerage for US investors. Next, do you have a clear idea for what you want to do with the proceeds, where you want to invest them, and you're ready to act on them right now? If you're not ready to act, I see no problem with sitting a little bit longer, again, to get to that 1 year threshold as a minimum. And then, as we get closer and closer to the deal getting done, stock price is going to move closer and closer to the actual deal price, right? So that's a thing to think about. Now, what about investing in another video game company? The first two that come to mind for me are Take-Two Interactive and Nintendo. These are very big companies. They're established. They have strong studios. Nintendo, of course, has that hardware advantage. The Switch 2 is out, and despite some initial concerns that, hey, maybe this isn't a big tech upgrade, sales look like they're doing really, really well. And the market is certainly looking at that favorably. Take-Two Interactive has grown a tremendous amount over the past decades. It has become a dominant studio, has some great intellectual property, has some sports games with some licensing deals as well that are real powerhouse games. So there's a lot to like. But two things that I'm concerned about when it comes to investing in video game companies right now. Let me share those things right now. The video game industry is, number one, it's mature and it's actually relatively slow growth, lots and lots of competitions. What that means is that this isn't some hyper growth area. And a lot of times investors forget that. It's also very cyclical, because there's the cycles of the consoles, there's a cycle of the games. When a new game comes out, these big blockbuster games that we see from these big studios, they have huge sales. The years that those new games come out are big, great years for those companies. The in-between periods are not as good, right? Now, it's important when you think about buying these companies that you want to get a good valuation. You want to buy when the cycle is going to be favorable in terms of new consoles, new game releases, and things like that in years to come. So I'm going to share this on the screen. We're going to take a look at price to sales multiples. Take-Two Interactive and EA on here. We're going to add Nintendo in just a second, but I want to start with these two first. So EA is being taken private in a little bit over 7 times sales, which is a very high multiple. If we think about it, we can go back to the 2020, 2021, like the peak kind of market bubble period. That's essentially back to the valuations that it was trading for back then. Now, some new games that are coming out. I think Battlefield 6 is going to be coming out next year. It's going to be a huge release. They've got other releases that are going to be coming out in the next year. So that's a little bit misleading, because again, there's going to be bigger results coming from those bigger games coming out. And then Take-Two Interactive, we look at it, it's certainly got a little bit of a lift here over the past few days from the EA deal. But again, it almost 8 times sales it's trading for even a higher premium multiple. Again, it has some IP that's going to be coming out over the next year that the market's already kind of factoring that into the price. So that multiple, it's expensive, but it's not as maybe as expensive as it might look. If we throw Nintendo on here, we can say, wow, it really blows the curve. But again, the Switch 2 is what is driving that. The early sales results for the Switch 2 have been very good. The expectations are it's going to be a mammoth holiday season for sales of the Switch 2. I've already talked to multiple family members that have told me they're getting their kids Switch 2s. And it's a very long period of time since the Switch came out. So it looks like there's a lot of pent-up demand, and that's expected to really make next year a great year for Nintendo. So that's one of the reasons the stock is trading for that premium. So I brought those up for a couple reasons. Number one, the multiples make them look more expensive than they are, but because those multiples have already come up, the market's already expecting great things for them to come. So that makes it, to me, these are a little bit less appealing. So I'm not very excited about buying Nintendo or Take-Two Interactive right now. I think, again, there's so much hype already built into their prices. I think there's going to be a better opportunity to buy those stocks down the road. Instead, I would look internationally at a company that I think is a good way to get some exposure to video gaming, but also some of the other major tailwind-driven things that are happening around the world, e-commerce and payments. That takes me to C Limited, ticker SE. I'm going to bring up a slide right here. So C Limited really does three things. They have their e-commerce platform, which is pretty large. They have a payments business that provides lending and also payment services. Shopee, of course, is their e-commerce business. Payee is this business, and then Garena is their digital entertainment business, which is their gaming business. Which struggled for a while, but we can see in the most recent quarter, year over year, strong growth in bookings for as kind of a proxy for revenue. You get 23% growth in bookings year over year. It's up a lot. But you can see their payments business is really growing very, very quickly. That financial services business, a little bit of the Mercado Libre model, and their e-commerce business continues to be really, really, really strong. So I think C Limited is the one of this group that I would be far more compelled to buy today because you get more diversification. They're expanding into Latin America. They're expanding across Southeast Asia. And that payments business, I think, as we've seen again with the Mercado Libre model, so many of the markets they're going into are still developing economies where they're very heavily cash-based societies. Building a digital payments platform, the lending products that they're building out, I think there's a lot to like with C Limited. Be sure to check out our special link with our sponsor, fool.com/unscripted. You can get access to the Motley Fool's 10 best stocks to buy right now.